Or waiting for a couple last people. Who wants to introduce themselves? Anybody in here wanna give me a little intro of who you are and kind of why'd you come to this class today?
I'm Nicole Edmonds, and I'm an agent with Keller Williams, as well as an investor. My husband and I have been fixing and flipping properties for about 4 years now. So I'm always interested in ways to finance.
Awesome. Thank you, Nicole. Do you guys own any rentals or just flips?
No rentals as of yet, but we probably will by the end of this year. It's on the
Cool.
plans.
Cool. This is the class for you then. Awesome.
Great, thank you.
Let's get two more. Cynthia, Candy, you guys wanna share what attracted you to the class today?
Hi, I'm Cindy Wilson. I came to Keller Williams Legacy end of August, beginning of September. I was coming from another agency, and I'm also an investor. And so I am looking to buy and flip and sell. I consider myself a real estate professional. So I'm here to learn everything I can about investing and finance.
Awesome. Wonderful. So Cynthia, also a flipper. Any rentals?
No, a deal fell through, and it still stings a little bit. Deal fell through for December on the seller side, but I'm still looking and taking that experience as part of the industry and keeping it moving.
Cool. Wonderful. Thank you, Cynthia. Alana.
So I am here to learn today. I'm not here in a coaching capacity whatsoever, because I've been talking about investing for years, and that has been one area that I can coach people nonstop to, but I'm risk averse and scared to take the leap. So this is my year.
Love that. Risk is one of the most interesting things. Thanks for bringing that up. We're going to talk about that today, because that is like how you value risk is so interesting. So cool. Thank you all. So first off, just want to introduce myself. Who am I? My name is Alston Carroll, and I own over 80 units. Some commercial, some residential, a little bit of everything. So that represents about $12 million in real estate. Last year, I did over 40 sales as an agent. So that's for clients. So that's just the investment deals. That's not even talking about, my whole personal, just first time home buyers, sellers, things like that. I own the Blue Key team. You'll see us in the right-hand corner of the PowerPoint there. We're based out of Keller Williams flagship nearby here. And last year we did about I personally did about 15 million in sales, and the team did like 26, 27 million. And so we're pretty consistently on the leaderboard if you see us in the region. And I'll turn 30 this year. So all done that in a relatively short amount of time. I was fortunate enough, if you all know who the McKitties are, Bo and Kimber McKitty, to kind of grow up in their organization. So as I graduated college from the University of Maryland, I interned there and then worked full-time there, and really got the crash course with Bo McKitty, learning about wealth and how you build that. And so it's interesting. I love that a couple of you all on the Zoom are currently investors, but you're flippers. We're actually teaching a course right now about wealth building, and there's this idea that flipping is a really great income generation source. However, it's not a great wealth building source. And so really what we're talking about today is a lot of the rental side. So how do you take some of those flips that you might have and actually look at them as rentals? And so we're going to talk about some of the financing that might be helpful in that. One kind of housekeeping thing, I would love an evaluation from everybody. So I'm on track to be a Keller Williams certified instructor, and this is one of the things that I need to do. So I have to get 75 reviews. So would love one from everybody. This is going to be at the end too, but if you're already on your computer, you could go ahead and go to kwueval.com. In that, you're going to pick the Maryland and DC region, the market center, level teaching. And then this course is not going to be in the drop down. So there's actually a selection for that at the bottom. And you just type in creative real estate finance. And then same thing with me as an instructor. I won't be in the drop down. So go down to instructor is not in, and then you can put Austin Carroll in. So I'll revisit that towards the end of the presentation here. So from my experience, there's really 6 things that you can be good at in real estate investing. And these are the 6 right here. Now we're gonna double click on number 3, but I'll go through all of them real quick, just so you kind of have an idea. And if you guys are interested in having me back for other classes on some of these other things,
Yes, we are.
we'll come back. So I have a class on all of these things. So the first one is construction and design. Love to hear that some of you are already involved in that. A lot of us can actually, we know home inspectors, we know contractors through our real estate sales business. And we also know investors if we work with them, so we can get referrals from them. So it's pretty easy for us to be relatively good at this. I also like to think that we should have a leg up on design because we walk through so many homes. So hopefully we don't make some of those silly mistakes that we see in some homes that we walk through. The second is finding deals. We should also be pretty good at this. Although I think sometimes as agents, we don't use opportunities to find off-market deals and things like that, which again, we can teach a class on that at some point. Number 3 is financing. And I think this is one of the easiest things to learn in a classroom setting because you can really just learn how to do it. And then all you need to do is make the connections and then figure out what resources you need to make that happen. So I'm excited to double click on that today. Number 4 for me is managing your properties. So this is talking about when you have that rental, how are you managing it, or how are you managing the property manager? 5 is financial modeling. And I think this is really just getting reps on like, hey, how do you analyze properties? And then you get to a point where you can really look and analyze properties in 2-3 minutes versus in the beginning, it might take you an hour or 2 to figure out how to do that. And then last is a little bit more of like a personality thing, but is being decisive and taking risks. I mean, we heard Alana talk about kind of like that mindset that's holding you back of like, what is risky, right?
Yeah.
And so really being able to shift that and figure out what is actually risky and what isn't. So all of those are classes. We can talk about some of those later, but we're going to talk about financing today. So I kind of listed out a bunch of questions that you probably want to ask yourself before you get into an investment. And so the first one is, do I need a cosigner? So a lot of us are 1099 employees. We don't have a salary that we're taking home. And so the question might be, I need somebody that needs to co-sign on this if it's a rental that I'm keeping or whatever it might be. Now we're going to go through the different types of lenders a little bit later and which ones might need that co-signer and which ones might not. The second and third question are, how am I financing this in the short term and in the long term? And so those of you who are familiar with flipping, you might be familiar with things like hard money, or maybe you can go and raise your own capital, which we're also going to talk about. So that's all short-term money, but then how do I get on the long term? My 30-year fixed mortgage, or I go to a community bank and find these other types of mortgages and things like that. So you really want to know that up front. What's my plan B, C, D, E, F? So I'll share a little story with you all. We currently have a piece of land that we bought in kind of northeast Baltimore City. We can build a 61-unit apartment building on it, or some version of townhomes as well. And we didn't really I haven't done much ground up construction, just a couple back when I was in the McKinney group, 7-8 years ago. And so we didn't really know what we were going to do with it, but we knew that it was a good opportunity and we could buy it. And then we talked to a developer that, worst case scenario, he would end up buying it from us. And so we actually went through that, what's our plan B, C, D, E, and F? And so we're under contract. We're in plan B, right? Plan A was to develop it. Plan B was, I probably don't have enough time to do that. So we're going to sell it to another developer and just kind of take the profit. Now we've got a C, D, E, and F where we've been working on financing in case that sale falls through and other stuff. And so you always want to make sure that you have that in your financing plan. I think there's only a couple ways that you really lose in real estate. And one big way that you lose is you run out of money. And then you have to have a forced sale. And then everybody knows that you have to have a forced sale. So they're going to offer you less, right? And so you want to make sure that you have those backups. How's my credit score? This is a good question. You can do some easy stuff to be working on that, certainly. And sometimes, it's something silly that you did in your past and you just got to work on that. What's the worst case scenario in financing, right? So that same land that we bought, it was the worst case scenario is I know I can sell it for what I bought it for, and maybe I'm out my financing costs because we just raised private capital. And so, that was certainly a consideration there. What happens if the appraisal comes in low, right? Do you have another lender lined up where you can get a new appraisal? Do you know how to challenge it? All of those different things. What happens if I go over budget? And that kind of leads into the last question is, what kind of reserves do I have? And so you want to make sure that you're having enough because, again, you don't want to run out of money. That's one of the biggest ways to lose. Any questions on this one? So let's talk about a little bit of vocabulary before we really get deep into the financing and like what are the strategies and stuff. We really have to understand a little bit of vocab. And so can anybody tell me what a pro forma is? Does anybody know? Anybody online?
It's usually an Excel spreadsheet where you plug in numbers, like the price point, your financing numbers, projected rent, so that you can kind of see what you're gonna be making on a monthly and an annual basis.
Yeah, that's exactly right. Thank you, Candy. It's really just a financial analysis, right? And so it's like, how do you know if it's a good deal or not? Well, you do a pro forma. And so there's a couple things that I want to highlight here in this pro forma. The first is that I think everybody should build a pro forma. There's lots of websites that you can go to that you plug in numbers and then it kind of like creates something for you and spits it out to you. But you don't really know what's going on in the back end of that calculation. And so you can learn a ton just by building your own pro forma. So this was one that I built and it's really not crazy. Like you don't have to be an Excel wizard to do that. This whole pro forma is built with a sum function. Like that's literally it. That's all I really know how to do in Excel. So everything in here is literally just like equals sum and then plus, subtract, divide, or times. Like that's it. And so this is an example of what mine looks like. So I would highly recommend that if anybody has any questions on that or is like trying to build one or wants mine, feel free to send me an email. I'm going to have my email at the end. And I think Alana and company here are going to send that out at the end. So the next one that I want to touch on is LTV. Does anybody know what that stands for? I'm talking to realtors, so you guys should.
Loan to value.
Loan to value. Yeah, that's exactly right. And so your loan to value is important because in all of this different financing that we're going to talk about, that's going to be so important for rentals and things that you're keeping. Because I'll give you an example. If you're doing a cash out refinance, which we're going to talk about in a minute, if it's a single family, you can usually go to 75% or 80%. So you can get a loan that's 75 or 80% of the value of the property. If it's a multi-unit, you can only do 65 or 70%, right? And so that is a big difference. It's like 10 to 15% difference in the amount of value you can take out of the property. And so you really want to know and have that in line in your financing plan before you go to do that cash out refinance, because you're expecting a 75% loan to value, and then you only get a 60%, you've got 15% you have to leave in that property. And that could be disastrous. ARV and BRV, that's just your after repair value and before repair value, right? And so we should be doing this sometimes for clients and things like that. Refinance, I do want to define it because sometimes people get a little bit confused about like, what is a refinance? And generally there's two types of refinances, which we're going to talk about in a minute. But the biggest thing to know is that it's replacing your current financing on the property. Or if you have no money, like let's say you bought the property in cash and you don't have a loan, it's just putting a new mortgage on the property. The next is your net operating income, or NOI. This gets a little bit more important when you're talking about commercial investments. So if you look on the spreadsheet that we have right here, the pro forma, you'll see kind of in the bottom right-hand corner, your net operating income. Think of it like your profit before debt service. So if you had no loan on the property, it would just be your profit. So that's the way to think about net operating income. It's every expense that you're going to have except for your debt service.
You said, what is it, net opposite what?
Net operating income,
Oh,
NOI, yep. And so this gets important because as you're valuing commercial properties, they're based off of the net operating income. So you're going to take, hey, what is my profit before debt service on this property? And then they're going to times that by something called a cap rate. And that's going to get your value for a commercial property. Next is appraisal. We all should know an appraisal is a third-party valuation. The thing to highlight here, and something to write down to ask any lender that you're planning on doing long-term financing for, is how do they get their appraisal? Because different banks will go about it differently. And I'll give you an example. There are some lenders, it was really common back in the day, but there are a couple lenders that will still do it, that will allow you to pick their appraiser that you want from their pool of appraisers. Now, the reason why that might be important is because, you know, we're in Baltimore City, right? And some of these properties are very hard to value. And so somebody that is mainly working in the county as an appraiser, and then they pick up a file in the city and they don't know how to appraise it, like it can get crazy. I just had an appraisal last week. We're refinancing our whole portfolio. And it's a 4-unit property on York Road, nicely renovated. And we expected the value to come in at about 400,000. The appraiser valued it at 200,000, and the comps that he used were only 2-unit properties. So it like boggled my mind why he would use 2-unit properties on a 4-unit. I don't know if he was confused or what, but that's something that now we're going to another lender that will allow us to kind of pick from a pool of appraisers. So we know, hey, these people do stuff in the city versus somebody that doesn't. So it's really important to know. Others will do just desktop valuations, right? We've seen some of that. And so that's important to know as well. Your tax assessment, this is important because sometimes people, and I'm sure we've had clients that get this confused with the value of the property, but your tax assessment is basically going to be what the city or the county or the state says your property is worth. And that's what your taxes are going to be calculated off of. So the way you think about your taxes is your tax assessed value times your tax rate of whatever jurisdiction you're in. So if you're in Baltimore City, I think it's like 2.3%. And so what's kind of cool about the method of buying something, renovating it and then refinancing it is a lot of times the city will keep it at that value that you purchased it at. And I'll give you another example. We bought a commercial building earlier last year, and we bought it for 1.5 million, and it was appraised, the tax assessed value was 2.1 million. And so we went through a third party and had the taxes challenged, and they brought it down to our purchase price of 1.5 million. Now, what they didn't know is that we were putting about $450,000 into the building, and now it's worth somewhere around 2.6, 2.7 million. And so we're assessed at 1.5, and we're really worth probably about 2.8 million. And so that's kind of a tool that you can utilize. It saves us somewhere around 8 or 10K in taxes every year, just because we're not selling it, we're actually keeping it, and they can see that we bought it 1.5 million. So cool little tricks that you can get. Free cash flow, this is just your profit. It's a fancy word of saying your profit. So with everything kind of factored in, your free cash flow is your profit. And then the BRRRR, we're actually going to go through that in a minute. I'll tee up anybody who knows what that is. What's that?
Was it free cash flow?
Free cash flow is another word for your profit. Yep. And so you'll see that as FCF. And then finally, your capital action reserve, your capital expenditure. This is money that you're going to outlay every 5 or 10 years. So this is like a new roof or a new furnace or things like that you should kind of be putting aside. And I wanted to highlight that because a lot of times people will leave that out of their pro forma as they're analyzing properties. And you should make sure you're putting a little bit of money every year away for those big expenses that come every once in a while. Any questions on this?
I have one question.
Yeah.
The LTV. So do you recommend, just with your strategy, going to the top of the LTV, or do you leave, some room? So if you can get 75%, do you recommend maxing out at the 75% and taking the money back if there is some to have, or do you like to be in the 60-65 realm?
Yeah, that's a great question. We really dive deep into that in an analyzing investment properties class, but let me give you kind of a short answer. It depends on your goals. So for me, my goal is the highest cash on cash return I can get. And there's 2 factors to a cash on cash return. It's how much money am I making every year? So what's my profit? And then how much money am I leaving in the deal? And so I would kind of use that as my barometer. If you look on my pro forma here, you'll see 3 green boxes. Those are the 3 metrics that I focus in on, and I make sure that I hit on all of my investment deals. So the first one is that free cash flow per unit per month. And so I want to make sure that's $225 a month. So let's say I could take out more cash, but then I'd only be making $50 a month because it brings down my profit. I probably wouldn't do that. So I'd probably want to make sure that I'm still hitting that metric. The second metric is something called your debt service coverage ratio. And this is what your commercial lenders are usually going to be concerned with. So let's talk about debt to income real quick. So when we have a buyer that is buying a house, the debt to income ratio is what the lender is using to say how much they can afford, right? And so it's literally just a ratio of how much debt do you have to how much income do you have. Think of the debt service coverage ratio as the debt to income for a property. So if like the property was a person, the debt to or the debt service coverage ratio is your debt to income. So it's basically how many times can the income of the property cover the debt service? And that's just the principal and interest. It's not all the other stuff, just the principal and interest. So for me, I want to see that at 1.75. Most lenders are going to have a floor of like a 1.25. So that's like kind of an important thing to look at. And if you're cash flowing, you're likely going to be above that. So that's kind of that second green box that you see there that says 1.75. And then the last one is that cash on cash return. So for me, I want 30%. That's pretty high, but it's because I'm renovating and pulling money out of everything. So those three metrics will kind of key me into, do I take more cash or less cash? Does that make sense?
It does.
Cool. Wonderful.
Thanks. So if I email you for your pro forma, do you have one sheet where you kind of have your metrics? Because I think that's where I've just been going off sometimes, just being a little random in my risk taking instead of being super calculated.
Yeah. Yeah. When you say my metrics, you mean like what my
Yeah.
like my floor is? Yeah. And it's going to
Yeah.
be the same that's on right here. It's 225 per unit per month, 1.75 and 30%. Those are mine. Right.
Okay. Thanks.
Cool. All right, so a little bit more vocab before we can really have an intelligent conversation around financing. And so the first one is seasoning period. So what this is basically a period of time that you need to own a property in order for you to do a refinance. And so most lenders want to see you owning the property for 6 months. Reason being, they want to make sure that, you know, you're not just kind of like cashing out immediately and kind of like using a velocity of capital that's like really, really quick. So there's some ways around this, and this is where you start to get a little creative, right? And so what they will limit is cash out refinances. Now, the definition, I'm going to get ahead of myself 1 second right here. A cash out refinance is basically just when you're pulling money out in excess of the mortgage, the current loan on the property. So it doesn't matter if you're making a profit, the term cash out makes you think like you're taking a profit. But it's really just if you're doing a loan in excess of the current loan on the property. So if you're buying a property for $100,000 and then you're getting a loan for $80,000 of that, and then you're putting, let's say, $20,000 of your own cash into the property. Now, let's say it's a really good deal and it's worth $200,000. You have $100,000 of equity there, right? But you only have $80,000 of a loan on the property. Now, anything in excess that you're getting a loan on above $80,000 is going to be considered a cash out refinance. But if you were to have that $20,000 that you were putting into the property as a loan on the property, then you would be able to take $100,000 out, so all of your money out, without waiting the 6 months. And so that's a little bit tricky to kind of conceptualize. But basically, if you have a $100,000 loan on it and you use $20,000 of that towards the repairs, now you're a rate and term refinance. You're just replacing the loan with your new loan. There's no additional cash that's coming out of that. And so those can actually be done quicker than 6 months. And so a little trick that you could do is if you're buying this in cash, you can actually record a higher mortgage on it. You know, let's say you have one entity that you could loan to another entity. And when I say entity, I just mean an LLC or something like that. And then so you're going to have a loan of $100,000 on that same property. And then at closing, you're going to get $20,000. And then that $20,000 you're going to use for your renovations on the property. And so that's kind of like a tricky thing that you can do so that you don't have to wait 6 months. Because if it's something where you're doing just a light rehab and maybe it's only going to take you 2 or 3 months or something like that, you're not just sitting there waiting 3 months before you can get the bulk of your cash back. And when I say rate and term refinance, that's where you're keeping the same loan amount or a lower loan amount, but you're changing the terms or the rate on it. And so let's say you have a hard money loan and it's a 8, 10, 12% interest rate. Well, now you're replacing that with a low interest, longer term loan. Does that make sense? Any questions on that? Go. All right, so let's go back. So that's kind of like the example of your seasoning period. And I'll just give you a real world example. So we bought a property like 3 weeks ago and we bought it in cash. and we bought it for $90,000. Now we're gonna put $25,000 into it. So we just took that $115,000, loaned it on the property to a different entity that we own. And then we're gonna refinance in like 3 weeks when the renovations are done. And we're gonna refinance at that whole $115,000 back. So we'll get all of our money back and we don't have to wait 6 months, right? And so that's like a very easy example of how that works. Now you wanna make sure that you have a lawyer that can do a mortgage and that the title company you work with is able to do that and all that stuff. But that's kind of like a real world example of how to do that. And what that does is it speeds up, you heard me use the term velocity of capital. And so think of if you have $200,000 that you can only turn over twice in a year because you have to wait 6 months in between. So you buy a property, you wait 6 months, and then you get your cash back and then you buy another property. You've only been able to get 2 rental properties in that year. Now, if you can do it in 3 months rather than 6 months, you can times that by 2. And so rather than waiting, only doing 2, you could do 4, 1 every 3 months. And so using a strategy like that can be a game changer between doubling how many rentals you have and really utilizing your cash in a really efficient way. Debt to income and debt service coverage ratio, we talked about that a little bit earlier. The thing to remember is debt service coverage ratio is what your commercial lenders are usually going to be using. Loan to cost, so we talked about LTV, loan to value. Loan to cost basically means that a lender wants to know how much you put into the property and they don't want you to take out more than a certain percentage. So there are some lenders that will only allow you to do 85% loan to cost. So let's say you have $100,000 into a property. Even if the property is worth $500,000, that lender only wants to give you $85,000. Reason being, you have $100,000 in costs and they only want to give you 85% of that. So that's something that you want to know up front and talking to a lender is like, do you have any loan to cost requirements? Loan limits. So this starts to be when you're talking about a community bank lender or something like that. They usually have limits on how much they can lend to a certain individual. Usually it's in like the $2 or $5 or $10 million range, but they're limited to how much exposure, which is one of the other words here, they have to somebody. So if you were to die tomorrow, they don't want to have $20 million of loans out to you. They can only have a certain amount depending on how big of a bank they are. And then the last one is loan committee. So there's this concept as you think about lenders that I like to think about that's basically 2 buckets of lenders. One is your check the box lender. That's kind of who we use every day for our clients. It's your Fannie Freddie lenders that say, hey, if you have this credit score, this much cash, and the property appraises for X amount, and you have income that's X amount, then you get the loan. Doesn't matter your experience, doesn't matter if you've owned a home before, none of that stuff matters. Then you have a loan committee type lender who's going to take all of these things into consideration and just make a decision on you, basically, on the project and on you. So it's not like, hey, if I do these things, I will definitely get this loan. Your loan officer is going to go to the loan committee. They're going to bring up all these different situations and, what's the property like? Does this person have experience? And then the committee is going to make a decision. Do we want to loan to this person? And at what terms do we want to loan to them? And so that's kind of the different way to think about lenders as we start talking about the different types of lenders.
Who was the first one you said? Not the loan committee, but you explain.
Just a check the box lender.
Oh, check
So
the
there's
box.
these boxes you got to check. And the perfect example is like any of your in-house lenders, primary residential or whatever, they're all going to check the boxes and then sell it on the secondary market. So as long as it checks the boxes, they'll give you that loan.
Check the box. Okay.
Yep, exactly right. Cool. Any questions on that? Go. Who knows what the Burr method is? I give you a little cheat sheet here.
Okay, so buy, rehab.
Yeah. Keep going.
Well, rent, refinance, repeat.
Yeah.
Oh, buy, rehab, rent, refinance. So let me ask you a question.
Yeah.
You got 80 properties, you say, right?
Mhm.
You got a mortgage on like most of them.
Yeah, except for the ones that we're actively working on, in which case we might own it cash or whatever it is. But yeah, pretty much all of them have. And this is the exact way. So, I'm 29 right now. I started investing I really started investing when I was 23. You know, I bought my first house at 21, and you know, it was an investment, but it wasn't really purposeful like it was starting when I was 23. And the whole way that I was able to build a portfolio like that, I didn't have hundreds of thousands of dollars coming out of college. I think I had like 15 grand or something like that. And so the whole way that I've been able to do that is, one, have a job where I make good income as a real estate agent, and then put that money right back into stuff. But it's also to recycle the capital. And so if you look at this picture right here, it kind of looks like the recycling bin, right? And that's the way to think about it, is you're recycling capital. And so you're buying something and you're rehabbing it. And when you're rehabbing it, hopefully you're getting some additional value out of rehabbing it. So you're putting money into it, but then you're getting a bigger increase in the value of it. Then you're going to rent it out and make sure it cash flows. And then you're refinancing. So you've created that extra equity in the property by rehabbing it and hopefully buying it right. And then with that extra equity, you're going to be able to get a bigger loan out on the property. So hopefully you can pull all of your money back out, or maybe you're leaving a little bit of money in it. Maybe you're leaving 5 or 10% in it, but that's still less than what your down payment would have been if you were to just purchase it outright. And then you're repeating it, right? If you're able to have deal flow, then you're repeating it at that point. Yeah.
Do you ever pay any of them off?
I'm sorry, what's that?
Do you ever pay any of them off?
Do I pay any of them off?
Yeah.
My goal is not to pay any off, right? And so this is like, if we were talking about a holistic wealth building class, we would actually, you would maybe consider that, right? If you're like, hey, I want to have 10 rentals and have them all paid off and just make cash flow from that, that's a perfectly good way to invest. Depends on your goals, right? I'm young, so I want to create assets, right? I want to have cash flow every month, passive cash flow, and I want to create assets, because what I also know is the more assets I have, the more I'm paying down a loan, which is increasing my net worth. So I've kind of gotten to the, you know, another class I teach and talk about is how you like go through your goals. And so a lot of people's goals in investing and owning rentals in the beginning is just about creating extra income. Maybe it's enough to replace your income or subsidize it so you feel really comfortable in just going out and taking bigger risks or whatever it might be. And then at some point that covers your life, and you're probably going to start thinking about something else. And so you might think about, well, I want to grow and create lots of assets. That's kind of where I'm at. So now I want to create and have bigger assets because I'm more interested in my net worth at this point. And so I know that the more assets I have, the more appreciation I'm going to get, the more I pay down a loan every year, you know, all that stuff. So it's less on the focus of free cash flow and it's more on asset accumulation. And then you might get to a point where it's like, hey, I just want to give back a ton, right? And so it depends. So it depends on your goals. The only time that we ever pay something off is just if we're going to refinance it at some other point. But we're going to keep our capital working. Or if I just like could not find any deals for some reason, then I might think about taking my extra cash flow rather than having it sit in the bank and pay it off or something like that. Good question though. Any other questions?
Oh, man, this is exactly something.
So this is just one strategy, right? Like the Burr method is one strategy, and I don't want to discount just buying a property like 20%, 25% down, because that's also a very valid way to do it. And it again, it's going to be kind of taking your resources into account. So like, do you have cash that you can leave in a property? If you do, and you don't want to necessarily be good at rehabbing or anything like that, then that literally just might be your strategy. Hey, I'm going to focus on my sales business. I'm going to kill it in sales. And then I'm going to take an extra 50 or 100 grand I make and save every year. And I'm just going to buy a property with it. That's a very valid thing to do. And so I want to make sure that we kind of have room for that conversation too, versus the, hey, I got to get all my cash back out of a property, because that is, it would be better for you to start today and leave money in a deal and just buy a rental and learn how to be a landlord than it is to like figure out this whole thing and then wait 3 or 5 years before you feel like you're able to do that. So I want to make sure that that's a conversation too. Cool. Has anybody heard of the 1% rule? Anybody online?
Yeah, no.
Candy, can you explain what the 1% rule is?
I mean, I find it kind of arbitrary, but some people, they don't want to pay more for the house, be all in than what is the 1% of the monthly rent that they're gonna be able to receive on it.
Yeah, that's a great way to put it. And here's what I would add to that. So you want to frame the 1% rule as being a relationship between the rent that's coming in and the value of the property. And so the 1% rule, Candy, I agree with you. One is probably a little arbitrary, like the actual number one, but you want to adjust depending on what market you're in. And so I'll give you an example first. I'll do this first one for you, and then I'm going to ask somebody to do the second and third example for me. A $200,000 property, if I'm using the 1% rule, it should rent for at least $2,000 a month, right? So 1% of the value of the property. Who can tell me what a $320,000 property should rent for?
3,200.
3,200, yeah. What about a $700,000 multi-unit?
7,000.
How many units in it?
7,000, yeah. A little bit of a trick question. I threw multi-unit in there. Hold up, is that different?
No, you can see how many units in it, then divide that by how many units in it.
Yeah, you
Divided
could,
by 7.
you could do that, like what each one should rent for.
Yeah, and then it go up to 7,000.
Yeah, absolutely. That's the way to look at it. So you want to look at the aggregated rent. And so in Baltimore City, we might actually be looking a little higher than this, maybe, right? Like depending on where we're at, because some of our expenses are higher than other places. So literally this relationship between rent and value of the property can be very different in different places. So like, let's take DC, where property taxes are like a third of what they are in Baltimore City. I can actually have a lower than 1% rule and it still works. So I might be using like a 0.75% or something like that in DC because my expenses are less, right? Or maybe I'm just like in a different market where I'm more certain that it will appreciate or something like that. So the whole idea here is just to be able to get a quick snapshot. So if I'm at a party and somebody says, hey, I own a rental property, I can really quickly know if they know what they're talking about or not. Because if they tell me they own a $400,000 house and it rents for $1,000 a month, I'm going to think that is a horrendous deal. And I don't have to do any sort of numbers or anything like that. But if they tell me they own a $200,000 property and it rents for $4,000 a month, my ears are going to perk up. You know, I might start asking some other questions of, do you include the utilities? Do you rent it by room? You know, because I know that's a really high percentage.
So if you got a loaner, a CPAP loaner, and you wanted to maybe like make it, let's go with the commission.
Denise, are you,
I'm muted.
okay, cool.
Got it.
So this is a really powerful tool for like very quick snap decisions. Now, some people will, as Candy was relating to, you know, you might have a client that says, I need a 1% rule. That's probably not the metric. And so this is like some coaching you can do as a realtor. You might actually ask them, well, that's a relationship that you're looking at, but like, what is your real goal? You know, it's kind of like saying, I want to make a lot of income. It's like, okay, well, yes, everybody does, but like, why do you want to do that? Right? Like, oh, I want more freedom, you know, or I want to be able to buy these things or whatever it is. And so when somebody says, I want to buy a property that meets the 1% rule, they probably actually mean they want to make X amount of profit a month or something like that. And so you can actually have a coaching moment with them where you say, okay, well, why is the 1% rule important to you? And they'll likely say, well, I heard it on a podcast, you know, or I want it to make X amount in profit. And then you can actually say, well, if I found you a property under the 1% rule, but it made you X amount of profit, would you still be interested in it? Right? And likely they're going to say yes. And so this is a really good relationship to use. And the other thing I'll say about this is at the low end of the spectrum and at the upper end of the spectrum of price, this gets a little weird. So if you're buying a $2 million property, it's probably not going to be $20,000 in rent. It's going to be lower than that. And if you're buying a $50,000 property, it's probably going to be more than $500 in rent, right? And so it really works. It works really well for like between 125,000, like 600,000. But if you get really to the extremes, you might want to, you know, kind of do a little bit more from there. The other thing is you always want to do a pro forma after this. So that's going to be really important. What is our time?
20 minutes.
20 minutes. All right, cool. Another consideration when you're talking about lending is this difference between, am I going to buy it in an LLC or my personal name? And so this is a conversation I don't think we have enough. And a lot of people just say the first thing you need to do is put it in an LLC. And I actually don't think that that should be the conclusion everybody gets to. The reason being is you've probably got 4 professionals that your job as an investor is to take their input and then come up with what the best strategy is for you. And so that's your lawyer, and that's your lender, and that's your accountant, and then that's like your title people, right? All of them are going to give you different advice. As an investor, your job is to kind of aggregate that and then put it into a strategy. And so your lawyer is always going to tell you to buy something in an LLC because they're worried about your law stuff. However, you go over here to your lender and you're going to have a lot of different lending options if you buy it in your personal name. You go over here to your accountant and he's going to have some sort of conversation around what your tax implications are, right? And so you're really taking all of those and putting them together. So I think the big reason why you would buy something in your personal name is number one, it's just easier in the beginning. If you're buying one rental property, you can perfectly easily buy it in your own name. Like I own plenty of properties still in my own name. The reason that you would buy it in an LLC name is if you want to protect your liability. However, if you're being a good landlord, you're likely not going to have something that comes up that is going to like sue you. Or like if you have, you know, $10,000 to your name, what are you protecting? You know, like the tenant is going to come after you and spend $10,000 with a lawyer to get $10,000. Like, you know, now if you're a high net worth individual and you want to protect some of that stuff, like that's a different conversation. But I see like people coming out of college all the time. They're like, I'm going to set up my LLC and buy my investment property. And it's like, well, hold up. Let's actually look at what it would be like to buy it in your personal name. Yeah.
What you feel about, I like the concept you said about buying in your personal name because it gives you more options that, you know, actually to purchase it. But say after you purchase it, you buy, you rehab, you refinance, and after you refinance, could you sell it to your, put it in your LLC?
Yeah, you can do something called a quitclaim deed, and this is where you want to start talking to your title. But you could take it from your personal, you know, let's say you bought it in your personal name and 5 years down the road, you've done really well. All of a sudden you're worth, you know, $10 million. And you're like, hey, I'd like to get everything over to an LLC. There are ways to do that. And the easiest would be called a quitclaim deed. So you'd go to your title and they would basically, you know, replace the current name on the property with your LLC name. Now there's some things that happen in that scenario. You might trigger what's called a due on sale clause. Where, you know, the title of the property is changing, so your lender might find out and then make you refinance. It's pretty rare that that happens, but if something were, you know, the economy went crazy or something like that, the banks are going to be looking at ways to get rid of some of those loans. So that might be something to be careful of. But generally, there are ways to do that, or you could just refinance into a different loan, change the title at the same time. So there are ways to do that, absolutely. So the lenders that will let you do it in your personal name are typically your Fannie Freddie lenders. So these are primary residential, right? DML. It's all these companies that we use with our clients on a regular basis. And they're going to, like, if you have good financials and stuff, it's going to be super easy to use with them. And it's usually going to be quicker. And it's just a very concise process. So that's the reason why you would, in the beginning especially, you might buy in your personal name. Now, if you're flipping, I always would recommend using an LLC because you have liability after you sell the property, right? Like they can actually come after you and say, hey, you did a bad job on this renovation or whatever. So that's where some like arm's length stuff is good. But if you're owning it and continuing to own it and you're a good landlord, then your personal name is not the end of the world. Again, kind of take everybody's advice and make your own strategy, but it's okay to buy in your own name. Any questions on that? Good.
I've sat in a lot of classes and a lot, you're absolutely right. You have so many people saying, you need this, you need this, you need this, do LLC. You can't do it without an LLC. And
Yeah.
it's like,
Yeah. Qualify who you're taking advice from too, because a lot of people that are going to tell you that, like, they don't own a rental property, but you got to have an LLC, right? Now, here's what I highly would recommend is that you run it as a business. And for some people, putting it in the LLC makes them think of it like a business. So what that means is keeping track of your expenses, running a profit and loss statement, you know, like having QuickBooks or some sort of software like that is really important because you want to know how your property is performing and you're going to need it for tax time anyways. Makes it a whole lot easier if you do. So just because you buy in your personal name doesn't mean it's not a business. The other thing I would bring up is partners. I have partners on a lot of my deals, mostly my best friend since we were 5. When I bought my first investment property, I had just a 1099 income. I had just quit my job at the development company, and I didn't have any leverageable income, so I needed somebody to co-sign for me. And he kind of took the chance on me in the beginning, contributed some capital. He co-signed. He had a solid job. Fast forward many years later, and now he's my partner on most of my stuff. And so the thing you want to think about with partners is what's your division of responsibilities, and do you have differing skill sets? And so you might not want to partner up with another agent whose skill set is finding deals that has no other skill set. But maybe you do want to partner up with a person that's good at construction or somebody that has a lot of money, right? So you want to think about these complementary things versus these duplicatable skills. Because sometimes you might be butting heads if you both find a good deal, but you only have enough capital for one of them, right? Like, who's going to do it? And so that's something to think about with your partners, and especially in the long term with things like that. And your personality, like, are you good with other people? Like, I'm very laid back, and so I'd rather have some leverage with a partner and things like that. And if I feel like I'm giving a little bit more sometimes, I'm totally okay with that. Other people are like, it has to be 50-50. I do 50% of the work. You're not pulling your weight, like, you're going to have an issue. So think about like who you are too. Cool. Any questions? So we're a little short on time, so I'm just going to do a quick conversation on risk. And this is something I talk in every one of my investing classes on. So, just come to another one if you want the long version of the risk. The big thing is you want to figure out what is reality and what was just kind of instilled in you in your environment. And so I'll give you an example. If you were raised in a family where your family was investing in real estate, your family friends were investing in real estate, then investing in real estate is probably going to be a low risk kind of thing for you to think about. If you were raised in a family where your parents were trading stocks and that's all they ever did, and all of their friends were only doing stocks, then real estate investing is probably going to be a really scary thing. And then same thing, like I grew up in Howard County, and I grew up on a farm. My parents, we never came into the city unless it was to do like, food at the church or something like that, to like serve at a food kitchen. And so my parents' view of the city was very different than what I think reality is. And I think that's actually a benefit that we have being near Baltimore City. So a lot of people have this negative stigma in Baltimore City when that really might not be the case. One of my favorite examples is that you talk to people about permitting and they're like, oh, Baltimore City is horrendous. These are people that have probably never done a permit before, right? But Baltimore City is horrendous. I heard they're backed up, all this stuff. And then they think about, oh, the county is much better at that. In reality, like that's something I hear a lot. In reality, the city is a fantastic permit portal. They're great. As long as you're not doing like big commercial stuff, then they're a little bit slower, but like for regular permits, they're great. And the county is actually really, really bad. And so the thing to think about here with risk is to know like what is reality, and let's actually figure out and go to those places. Like people are talking about neighborhoods and they haven't been there in 2 or 3 months and they haven't walked around in those neighborhoods. Then you might want to figure out how you get to those neighborhoods to walk around and find those things. And one of the areas we love investing in is Cherry Hill, which a lot of people that have a thought of Cherry Hill from 10 years ago, like it's kind of scary for them. Like you'll immediately see this like visceral reaction of, oh, you invest there, right? And and those are some of my favorite tenants, some of my favorite houses. Like I don't even like to talk about it much because I'm like, yeah, everybody keep thinking what they're thinking, right? Like I'll keep buying houses there. Now there's a distinction in the city between Cherry Hill and Brooklyn, like that's a very big distinction. But there's these small pockets that I think people don't really go to and visit. They just have this idea of what it's like. And so there's an exercise that I teach in some classes where you write down like 5 or 10 different either areas or types of investments. And then you think about why that might not be true. Like, why might that not be a risky investment? And so this past week I taught a class on that, and somebody said, I think about hotels as being a risky investment. And then they actually thought about it and they said, well, maybe it's not. Maybe it's higher cash flow than I think it is. Maybe there's good buying opportunities right now. Maybe millennials are getting tired of Airbnbs and actually want the hotel experience, which is actually me and my wife's experience, right? Like we've stopped doing Airbnbs and we started doing hotels. And so like it's thinking about and opening up the possibility that what you think might be actually opposite what it is. And I think that's the way that you kind of confront and figure out like what is risk, is you have experiences and then you open yourself up to and look at what the opposite of that is, and is it true or not? That's a little bit of a tangent on risk. Any questions on that?
Yes, I have a question.
Yeah.
If you don't mind speaking to your experience as a landlord during the COVID period, did you suffer any loss? And if so, how did you recover if you have?
Yeah, almost none for us. I love investing in like work class housing. And what that means is it's like your people that are like the cleaners at the hospital, right? That you're like a reasonable rent. I'm not investing in student housing. I'm not investing in, young professional stuff in Canton and Fed Hill or, anything like that. I'm investing in the neighborhoods where like your normal people live. And so I think part of it is we just got a little bit fortunate that almost all of our tenants continued to be able to work. And the handful of them that weren't able to were really proactive and applied for rental assistance. And then, we have a high cash flow portfolio. So it was a while that we didn't have cash flow. But then we got all of it from the city. Like there were actually like, if you had a motivated tenant, they went through a process, and we've had people do it 2 or 3 times where they've gotten money multiple times from the COVID relief funds. So I think if you're smart and you're coaching your tenants on how to do stuff like that, then, you had a decent experience through COVID. So that's another thing that I think a lot of people would like, when COVID first happened, like people were like, oh, you must be devastated with like your portfolio, like nobody's paying rent, right? And then you look at the reality of it, and actually most people paid their rent, and then the handful that didn't went through the rental assistance. And there's only like 1 or 2 difficult tenants that we had that didn't want to do that. And then, 2 out of 84 units is not bad. So good question. I'm a fan of Section 8 and other. There are other assistance programs too that I'm a fan of. We probably have like 60% of our portfolio has some sort of assistance. I think the biggest thing there is make sure you're still screening your tenants. Early on, when I first started investing, we had a tenant that was running like a drug and prostitution ring out of a unit.
Oh my goodness.
It was crazy, right? But we always got their rent, but the community was like, crazy. They were like, this is the worst house ever. And so we had to go through a different avenue to get her out. And our lesson from that was still screen your tenants. And so like some of my favorite tenants are Section 8 tenants. Like one of them like found me on Facebook and wishes me like every holiday. He's like, hey, happy Memorial Day, like happy birthday, Austin, like all this different stuff. And it's like, wow, like that's a good tenant, right? So yeah, I'm a fan. One other thing to touch on is recourse versus non-recourse loans. It's just a fancy way to saying a recourse loan means that you are individually liable to pay that property back. And a non-recourse loan, you are not. So you are not actually signing that you will pay that fund back. So if that asset started to perform badly, then the bank had a right to take that property back, but they can't go after you individually and sue you for the rest of the money. And so that's an interesting distinction when you get into like higher level stuff. So like the building that we're in right now, like if this were all owned by one owner, it's probably not one person that would be responsible for paying that back. You're going to use a type of financing where they're going to say, okay, this asset is performing. And if this asset stops performing and this person stops paying me, then me as the bank just has the right to go in and take the bank or take the asset. Now, likely they don't want to do that because they paid money to buy the asset. So there's like this, this idea there, but it's a way to keep you from, when you own lots and lots of properties, to just be crazy, on the hook for, again, like for me, it's like $12 million, right? So if I were on the hook for $12 million and, I died tomorrow, and the assets stopped performing, like where are they going to get the money from? Right. So that's the idea. And really, this is going to be on the upper level stuff. So this is commercial, this is big buildings. But when we're talking about assets and different types of financing, that's a conversation you want to start to ask the people. I think this is, let me check something real quick. Yep. What's our time check?
Minutes.
Fine. All right, cool. So this is our last slide right here. And we could probably spend 15 minutes on every one of these, but I just want to give you an idea of the different types of lenders that are out there. And I'll give you some examples of ones that are in our area. So the first is hard money. And hard money is short-term financing, usually less than a year. And that hard money is going to be, you're gonna have fees, then you're gonna have points, and then you're gonna have a high interest rate. And so your fees are like, hey, the lawyer puts this together, it's gonna cost $1,500. And then you're gonna have points, which are usually a percentage of the loan amount. And so you'll hear that reflected as just a number. So they might say something like 12 and 2. And that means that they're charging 12% interest and 2 points. Most of the time, they're not gonna tell you the fees, but you should also ask what your fees are. So that's kind of hard money. They're usually just lending on the property, and maybe they're gonna take into account like your credit score and your income, but usually it's just like on the property. This is like the easy way of doing a BRRRR method, is you're gonna finance something on the front end with hard money. They usually will give you money towards construction. And the biggest thing that they're gonna be looking here is what is the property worth after repair? So they're really gonna be focused on ARV. And usually they're somewhere in the neighborhood of 60 to 70%. So they will lend you on the front end somewhere between 60 and 70% of the ARV. The second we've talked about, and you guys should be familiar with these, they're your Fannie Freddie loans. This is your regular mortgage broker that's going to, if you check the boxes, you can do this. And I think being creative in this type of lending in the beginning is really, really important. And so you could, like most people don't know, you could buy an investment property 15% down if it's a single family home and do a construction loan on it, right? So rather than using hard money, you could actually do that if you're really bankable. Most people don't realize that and know that. So understanding kind of like where the guidelines are here, and you might even need to go to a lender that's like not your cookie cutter. We take good people with only good credit scores and all that stuff. Like you might want to find some of those lenders that like understand kind of the fringe and edges of what you can do there. And if anybody needs examples of that, let me know, because if one lender in the Fannie Freddie world tells you that you can't do it, it doesn't necessarily mean that it's not true. So if you guys have any questions on that, like we can dive deep into that at a later point. The next is your community banks, and these are like your natural next step up once you are like, hey, I want to buy in an LLC. And so these are lenders like M&T Bank, or it used to be Revere, now Sandy Spring, Eastern Savings Loan and Bank. And these guys are going to be the loan committee type lenders. So they're going to kind of consider a lot of different stuff, and you're going to be able to buy in an LLC with those. The next one is what I would call national community banks and fintech companies. So fintech stands for financial technology companies. And that's probably the biggest change you've seen in the last 5 to 10 years in finance, is that all of these financial technologies companies have started to say, hey, these community banks actually make a lot of money, and we could do the same thing on a national basis. So we're going to go raise money from Silicon Valley and Wall Street, and then we're going to come offer some things to the consumer. You're also seeing some companies that go out and they raise these big bonds. So they'll raise $100 million from Wall Street, and then they'll go loan it out to LLC type people. And so a couple of good lenders on this is like Pimlico Capital, Dominion, the Dominion Group, like those guys are local. And there's a whole handful of other ones, Lending Home, Lima Capital. And these are actually, they're becoming really, really competitive. But what happened at the beginning of COVID is a lot of these guys shut up shop. You know, they were like, we don't know what's going on. And so they like really contracted. And so if you were only having relationships with them, you actually got caught a little bit in trouble. So that's the thing to keep in mind with them, is they can change very, very quickly. Then you got your Fannie Freddie small balance loans. And so these are multifamily above $1 million. And the cool thing about this type of loan is it's non-recourse. And typically they're lending based off of your net worth, not off of your income. They're going to consider your income, but they're not going to want to lend you more than what your net worth is. So that's something interesting. That's kind of like, again, the next step up. And they have really competitive rates and stuff like that. Next, you got your private capital and cash. This is my favorite one. And if you have the ability, like being able to create some efficiency and being able to raise capital versus go to a hard money lender is really going to change your life in investing. So like we raised probably somewhere around $5 million over the last couple of years. And we just raise it and we pay people 9%. You know, so people get a really good deal. Like they give us money and then we get them on an ACH where every month they're going to get interest check from us. And then if that's how you want to invest, like that's a really good way to invest. And then we take that money and we buy big stuff with it, or we'll buy properties in cash. And so our cost of capital goes from like, 12% and 2 points in something like hard money to just 9%, no fees and no points. But people want to know that we know what we're doing. We have a lot of experience and things like that. So if you start off and you start borrowing, cobble together $100,000 with 10 friends or family or coworkers or something that have $10,000 a piece, and then return their capital to them, and then they'll probably be willing to give you $15,000, right? And you just kind of like go up from there. And so I think that's something that a lot of people go straight to a hard money lender, and they don't actually ask around to see who has capital that they can borrow from. And that can be a game changer and save you thousands and thousands of dollars. And then lastly is a line of credit. And you can do this on your personal name, or you can do this with your business as well. And so, so that's kind of like the last thing to really consider. So I know we just ticked over there. So if you guys would like to have this back, like let your leadership know. If you guys are interested in any other courses, happy to have them where we're talking about analyzing properties and things like that. Please do a KWU eval. You can do this on your phone, or you can do it on your computer. I'm going to hang out for a couple minutes and answer any questions here. One other thing is we're continuing to do some more classes with Bo and something called the Empower Network. And so if you're interested in like this times like 4 or 5, where we do like a series of classes, then we give you some homework and you work on that. Go to empowerneighborhoods.com or shoot me an email or follow me on Instagram and send me a message. These are usually paid classes, but they're a lot more in depth, and they're going to be like a multi-week series. So empowerneighborhoods.com, shoot me an email. I'll send it out to you guys as well, Alana, so you can send that out.
Yeah, definitely.
And I'll hang around for a couple more questions. If anybody has any questions, just kind of about anything investing. Yeah, I've got another 30 minutes or so to hang out. So thank you all for coming. Let me see, was there anything else? Yeah, we'll leave it there. Actually, let's leave it here on the info. Anybody have any questions?
So we offline now?
They're still on, yeah, but
What we gonna ask? You alone, you first. You first.
I'm filling out an eval right now.
yeah.
Austin, at one time, a lot of the liability people would say things that once you get your first LLC, maybe only hold about 5 properties. And so the other people go LLC for each property. Where do you kind of see it?
Yeah, good question. So the question was, do you create one LLC for every question or every property, or like do you bundle enough together, or like what does that look like? I think you want to understand the risks here, and then you kind of make a conversation around what that is. So the risk is that if you have everything in an LLC, if one of those properties sues you, then they could have everything in that LLC. My thought is that, yes, there probably is a threshold somewhere in the neighborhood of $5 million or so. That's like my personal, because $5 million of real estate probably equates to $1 million, $1.5 million in equity, something like that. And it's like, that's kind of the conversation there. The big thing that I always like to have people think about is the one thing that people are going to sue you over is negligence. And if you're just being a good landlord and showing that you're actually like repairing things and stuff, then you're probably not going to get sued. And if you are being negligible, it doesn't matter if it's an LLC. They can do something called piercing the corporate veil, where they basically say, hey, Mike, I don't care if this is an LLC or not. You did something so bad that these people deserve to get paid. And it doesn't matter if you have all these other LLC protections. We're going to just offset that, and you're going to have to, liquidate those and stuff like that. So that's kind of like the thinking is like, don't be negligible and you probably won't get sued. And if you are negligible, then it doesn't matter if it's an LLC. So that's like lead. Lead is one of those things that they can take everything that you own. Doesn't matter if it's an LLC. Maybe if it's in a trust, it's protected, maybe. But that's a whole nother conversation about layers of structure and things like that. Good question though. Anybody else
That's a
online?
quick question.
Yeah.
All right, so let's go to the beginning. So let's say you got a rental property. You're gonna do a cash out refinance. You give back 100,000. What would be your next move?
Find another one.
Buy another rental property?
Yeah.
Would you flip it, or would you just do another rental and do the same thing all over again?
No, just keep another rental, right? Because like, let's say that scenario, now you're making $300 a month in profit from that rental property.
Mhm.
You got your $100,000, now you go do another one. Now you're making another $300, you're making $600 a month, right? And like, that's the whole idea, is to build this cash flow. Now, 3 years down the road, I'll give you another example. And I talk about this in another class too, where you have these long-term arcs that you don't really know about until you do it for 5 years.
Mhm.
And then you look back and you're like, wow, that property, I only have a $100,000 loan on it and it's worth $250,000 now. And so now you take a big, like another cash out refinance. So like, we just did that on a 2-unit that we've owned for like, I think it's one of the oldest ones that we currently still own.
Mhm.
We've owned it for like 5 years or something like that. And then our loan was like $130,000. And then it got appraised for $310,000. And then, so we just took $100,000, right? And that's not taxable income. I'll pay taxes on it when I sell the property, but I'm not paying taxes on that today. I'm just getting a new loan on it. I'm getting $100,000. Now we go buy another property with that. So you have these like short-term cash flows.
You got the property, you bought another property, and it went up to like 300,000. So you took the 100,000 out of that 300,000. It's still left the rest of the money in it.
Yeah, so we got a new loan, right? So the new loan was like $230,000, paid off the old loan, $130,000. We got $100,000 at closing, and then we used that. Now we've got a loan of $230,000. So our debt service went up. Actually, our rate went down, so it wasn't crazy.
It was like you got a 300,000.
Yeah.
Oh. Okay.
So that's like the power of it, right? Like over time, the people that like trade in and out, and if you guys have listened to Gary Keller's Think Like a CEO podcast, really great last season on that, where he talks about wealth building. One of the big things he talks about is not revisiting your money. So not selling your investment properties. It drives me crazy, as much as I love it, when one of my investors that bought a house 1.5 years ago as a rental, then goes and sells the property 1.5 years later. And it's like, well, that you're not building wealth, you're just creating cash for yourself. And then if you're not redeploying it or doing something smart with it, then what are you doing? And so I think that's one of the big things, is like, hold on to stuff, and like let time do its thing. And the more you let time do its thing, the wealthier you're going to be. And then you're going to look up one day, like we did, and be like, wow, this property we bought that property for $115,000, put like $20,000 into it. So it's already a great deal. And now it's like, wow, this thing cash flows really good and all that stuff.
So they don't have a limit on how many loans they can give you?
There are limits per lender, and then there would be limits with your, if you're buying it in your personal name. But I think it's like 10 or 20. It depends what investor they're selling it to on the back end. So you've got, Fannie and Freddie are both different entities, and there's Sallie Mae and like all these other Penny Mac.
So if you run out with one lender, you just go to a different type of agency.
Yeah, you're not gonna have limits on your LLC loans usually. But on your personal loans, you do have regulations around how many you can have. And I think the number is like 15 or 20. And so when you get to that, then you can just figure out, okay, how do I get these into an LLC and then refinance it to a different lender?
And how about your credit score? That just doesn't mess with your credit score? I mean, no.
I've got so many pools that like, yeah, it's kind of silly, right? Like all my bills are on time. I have very low debt in terms of like my continuous debt, but I've got like 12 credit pools, because they're just constantly doing it, because I'm constantly buying things, refinancing it. So that does hit it,
So
but
what's your credit score about then?
it's like 720. It changes between like 720 and 760,
It's still up there?
Yeah.
It doesn't sound like a bad idea, man.
Yeah.
I'm like that at 757 right now.
Okay. Yeah. It'll go up and down. I mean, like it's kind of crazy when your investor stuff happens. But once you get to a certain level, they start to understand that.
Right.
Like, hey, it's just because I have a ton of credit pools on here.
Right, and that's what you doing.
Yeah.
Yeah.
Yeah, you know what I'm doing. Yeah. So, anybody online have any questions?
Yes, I have a question.
Yeah.
You mentioned it's a good idea to maybe partner with someone. And I agree, that's a good idea. What about some of these investment teams? How successful or profitable would it be to join an investment team?
What do you mean by investment team? Do you mean real estate sales, or do you mean like a syndication?
Well, I'm really interested in purchasing rental property. Are the investment teams pretty much focused on flipping properties, or do you know of any that go in? For example, maybe your broker offers that opportunity to join an investment team.
When you say team, do you mean like a sales team?
Well, I'm not sure, because I wanted to know if you have any experience with investment teams.
Yeah. So I would, there's something called syndication where you can be a limited partner on deals. And so we actually do these for like our larger commercial stuff. We'll usually keep 50% ownership, and then we'll have other people come in. Usually it's relatively large amounts of monies, 50, 100K that you're giving us to invest in a property. So if anybody's interested in something like that, shoot me an email and I'll add you to the list of opportunities that we have with that. That would be, I think, the biggest like leverage thing that you can do. So if like you didn't want to figure out how to do this and you just wanted to like, invest in somebody that knows what they're doing and, has kind of a strategy and stuff like that, a syndication would probably be the way to go.
Okay.
So that would be something. So if you have any questions on that, shoot me an email or something and we can chat about different things like that.
Okay.
The one thing I would say about that is just be careful who you're giving money to. Because you can lose all of your money in a deal like that. Now, generally you can't lose any more than that as a limited partner, but just be smart about who you're doing it with and make sure it makes sense, right? Like usually like we're only syndicating big deals. So things that are like $1.5 million or more. If somebody's syndicating something for like a single family home, it's $200,000. It's probably not going to make sense in the long run because they're not going to get enough from it. So
Right.
then you're going to have a situation where they just sell the asset, give you back your money, and you're just kind of wasting some time.
Okay, great. Thank you.
Yeah, good question though.
I have a question. So do you only deal with investments far as just real estate, or do you deal with investments as far as stocks as well as in companies and things like that? If a person was interested in buying stocks in a company.
Yeah, good question. I personally have owned stocks. I don't own any stocks now because I can make a much higher return in real estate. But it's funny, I went to University of Maryland Business School, and a couple of the guys that I graduated with went to like Goldman Sachs and like all these Wall Street firms. And so we like for a long time, we would meet up afterwards, like every year we would go back and we'd have these debates about like real estate or stocks and real estate or stocks. And it's funny because a lot of them have started to buy real estate and are investors in me, but I'm not buying stocks.